Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we know, the economy is weakening and the equity markets have been under severe pressure over a number of weeks. I wanted to bring in a Wall Street and Bay Street veteran to share insights in terms of where we're at and perhaps what happens next. And for that, David Rosenberg is joining us. He is the president and founder of Rosenberg Research and Associates, an economic consulting firm, and very, very well known really around the world. David, great to see you. It's been a while, but we've been talking to each other for many years. Thanks for being with us. And how are you doing in this market?
Well, in answer to the last question, no matter how I'm doing, it's certainly a lot better than Mr. Dow and Mrs. Jones. And I want to thank you for inviting me on. It's like the old days, except in the old days we would do these in person. But
We
thanks
sure
very
would.
much for inviting me on the show.
Well, thank you. And David, so many people do see your research, want your research, listen to your thoughts. So let's get right into it. I mean, we had an inflation reading in the States this morning. We pre-taped this, it's Thursday. That was double expectations, 8.2% headline year over year. What's your interpretation, though, in terms of inflation and where we're going next?
Firstly, we know that inflation is a lagging indicator, and it usually actually peaks, not unusually, 6 months into a recession. And then with the lagged impact of the demand destruction that comes along with recession, inflation falls like a stone. I still think that's going to be next year's story. Today's number was a huge disappointment. Not so much the headline. It was a battle there between food going up and energy going down. It was the core index up 0.6% for the second month in a row. And I believe the year over year trend at 6.6% on the core index, the highest since August 1982. So even if you have this
Mm.
view that inflation is peaking, it's not peaking in the core index. And that's a big problem for the Fed. This is a sort of a situation where this is going to push the Fed to tighten policy harder over the near term. And that means that, ironically, that the higher than expected inflation print today is going to sow the seeds for more disinflation or deflation down the road, because it means that the Fed is just going to step on the brakes that much more over the course of the next several months.
So, cause a deeper recession, perhaps.
Cause a deeper recession, and every recession, even in the three recessions we had from 1970 to 1980 in that stagflation period, in recessions, demand overwhelms supply and inflation falls. Treasury yields go down. I don't think it'll be different this time. And again, just back to that CPI report, it was a very wonky number. I mean, it was dominated really by things that are outside the Fed's control, dominated by food. It was dominated by medical care services, dominated by the rental components, which are 30% of the entire index. And when you look at medical care services, education, and food, there's not much, like I said, the Fed can do about these areas. Everything outside, I mean, those areas collectively were up 0.8% month over month. The rest of the CPI was actually flat. Now, people will
Hmm.
say to me, "Well, that's fun with figures, and you're sort of manipulating the analysis." I'm just trying to say that it wasn't a ubiquitous increase in prices. It was confined in areas of the economy that the Fed can't do much about. But I wouldn't want to be in their shoes, because their big concern is no matter where the price increases are coming from and whether or not it's in lagged areas like rental rates, their big concern is that it's going to feed into wages and that inflation expectations are at risk of becoming unmoored. They actually made this point emphatically in the set of FOMC minutes that just came out. So that's the problem. We know about the transitory story, but the fact that inflation is remaining persistent, the problem for the Fed is that it feeds into inflation expectations, which have been remarkably stable these past several months. But for
Hmm.
the Fed, that's the risk, is that that could unwind so long as these numbers don't start to subside, and they certainly didn't in the September CPI data.
But it seems as though the Fed is continuing to chase the inflation numbers, and yet we've talked about this food and energy. I don't know how they can possibly control that with the war in Ukraine. We're going to take a quick break. We'll be right back with David Rosenberg. David, I want to pick it up in terms of what the Fed is trying to do and trying to chase in terms of combating inflation. Yet these are areas, energy, they don't have much control over that because we haven't had enough production in North America, at least for the past 10 years. And also, of course, food inflation with fertilizer prices going up, the war in Ukraine. We talk about shelter as well. But if they can't control this, what are they doing? And what should they be doing?
Well, their primary concern, Catherine, like I said, is how this plays out into inflation expectations. They know that the higher the inflation readings remain elevated, the greater the chance that we will get into a wage price spiral. We haven't been in a wage price spiral. The inflation bulge, which really was caused, as you said, COVID, the prior fiscal stimulus, the prior massive monetary stimulus. A lot of these things are in the rearview mirror. But we have to face facts that even though the US economy, and you could say the global economy, has been flat in its back all year long, and this is when you get into some stagflation concerns, despite the fact that you've seen the weakness in demand, especially in the goods components of the economy, the inflation is remaining very stubborn. And I think you and I would both agree, and you'd mentioned the fact that it is a lagging indicator. The problem for the Fed is that the higher this lagging indicator stays elevated, the greater the risk that it feeds into union settlements, it feeds into wages. And
Hmm.
then we're in a real pickle because that's when you get into a period where inflation expectations become more embedded in the economy. So what they're trying to do, they realize, I'm sure they have to realize that the rental component in particular is going to lag and probably won't start to subside until we're past the first quarter of next year. Uh, Medical care services, that was an education services. They were big surprises in that CPI number. What does that have to do with the economic cycle or the Fed? Not much. What they have to do, therefore, is they have to really crush inflation in the other areas of the economy that haven't been crushed yet. We
Hmm.
haven't seen furniture prices come down. That has to happen. We haven't seen delivery services come down. That has to happen. We haven't seen home improvement. Home improvement is actually booming. We see that in the spending numbers, and you saw it. The inflation numbers in home improvement are incredible. We know that's an economically sensitive part of the economy, yet pricing trends in home improvement are skyrocketing. The Fed has to crush those areas, basically. So they have to generate the conditions for a recession. I don't think a mild recession is in the cards. They have to generate the conditions for an outright demand contraction in the areas of the CPI that they can't control. And a lot of
You
those
know,
are in the economic cyclical areas. So I think that's really the name of the game.
Well, and David, the difficulty with that for, regular individuals, all of us, is that, you've got a central bank, whether it's in the United States or maybe in Canada. I want to touch upon Canada as well. That's kind of choosing the winners and losers just to make sure that there's a reset within the economy.
Well, I think that the way the Fed looks at it, from a, I guess from a social policy standpoint, is they view inflation as a tax on the poor and the elderly. So they view inflation as hitting the most vulnerable parts of society the most. And so they fully well realize that higher interest rates are going to hit borrowers. They understand that the housing market is various states of disarray. We know auto sales have been below replacement demand for the better part of the past year, and even that's happened even though inventories have started to pick up. They know the impact that their policy is having, but they want to crush inflation. They certainly don't want to have inflation expectations, which have been really stable. Their concern is that the longer we get CPI prints like this, the more it's going to feed into expectations. I think that's their primary concern. And then you get inflation embedded in the system. Maybe not like
Hmm.
the 1970s per se, but call it 1970s light. That is not a
Hmm.
good economic outcome. So look, Powell
Hmm.
told us Jackson Hole. He said, "Be prepared for pain over the near term. Be prepared for pain." And I think that he would basically add to that the tagline, "Short term pain for long term gain." There's no other way out of this. He compares himself to Paul Volcker. Paul Volcker was, we revere and love Paul Volcker today, but he did engineer back-to-back recessions in the early 1980s. He was reviled, if not detested. And then, once he crushed the inflation, and look, we got down to an 8 multiple on the S&P, the unemployment rate
Yeah.
doubled. We remember that, Catherine. It was a painful, really 2 to 3 year period, and it paved the way for 20 years of nearly uninterrupted economic growth and a bull market in equities. So, the phoenix did end up rising from the
Hmm.
ashes, and so I think that's what they're thinking right now. For the near term, it's going to be very tough, but they're really looking, trying to pave the way for getting back towards price stability, which generally leads to positive economic outcomes.
David, I just want to go back to a couple of things that you mentioned in the previous segment. One is from a social perspective, I think we can understand, the Fed concerned about the poor and the elderly for sure. One of my concerns, though, in terms of doing this demand destruction and causing perhaps a deeper recession than people have been anticipating, because there's a lot of pundits out there who think that the economy is actually still strong. We're going to muddle along. It's going to be okay. I hope it is. But it doesn't sound as though that's the way you think it's going to be and the way the Fed is indicating it will be. In other words, short-term pain for long-term gain. My concern is on the employment front. The employment picture seems to still look okay. And that's what US President Biden continues to say. The job market is strong. But you point out that the jobs market is a lagging indicator. So my concern is everybody who's kind of at the prime of their working life, like what do they need to prepare for in terms of their job prospects?
Well, I think that an answer to the first part of the question is that we have a situation on our hands in the labor market where it's artificially strong. Not all jobs are created equally. You get these non-farm payroll numbers, and everybody says, "Well, look at the employment increase." Meanwhile, in the past 4 or 5 months, all the job increases have been in part-time. So companies are actually rationalizing on labor without firing anybody. Of course, that's the ultimate pain is firing somebody. But when you furlough somebody from full time to part time, or you cut the work week is down at about a 1.5% annual rate so far this year. It peaked last December. And actually, out of all the labor market indicators, the only one that goes into the Conference Board's leading economic indicator is the work week because hours traditionally lead bodies. Companies are actually rationalizing right now, and at some point, I think they will have to make the decision as to when they start to lay people off. And you're seeing that in the Challenger hiring and firing announcement numbers, which are leading indicators that next year is going to be a completely different labor market. The Fed laid the cards on the table, Catherine, in their last set of forecasts at the last meeting. They told us that the unemployment rate in their forecast is going to 4.4%. 4.4%. People say, oh, that's still pretty low, but it's not about the level, it's about the change. Because right now we're 3.5%. And whenever you've had the unemployment rate go up 3 or 4 tenths or more from a cycle low, you're in an outright recession. Now, we're not there
Mm-hmm.
yet, but the Fed gave us valuable information that next year they see the unemployment rate of 4.4. I think it's frankly going to be higher. But even you go to 4.4, which is where the Fed is telling you they want the unemployment rate to go, that's their forecast. So I don't know people that talk about the labor market today. Who cares? It's where is it going to be 3, 6, 9, 12 months from now? That's what really should
Mm-hmm.
matter for investors. The Fed's telling you outright that they're going to create the conditions for a recession. They're telling you that the last leg of this is a labor market and that they're going to create the conditions for almost a full percentage point increase in the unemployment rate, which, depending on what the participation rate does, you're talking between 1 and 2 million jobs lost over the course, say, of the
Mm-hmm.
next 12 months.
Hmm.
And that's what
And
the Fed needs to see. The Fed wants to see demand growth subside. They want to ensure that wages do not get unmoored because of these inflation numbers. So I guess your point is quite, it is funny that I talked before about that all of a sudden Jay Powell is the resident social worker and talking about inflation as a social ill. At the same time, people are going to be thrown out of work. It's not going to be like the last recession or the one. No two cycles are the same. But we're not getting out of this without job losses. And we're not getting out of this without labor input going down. That is absolutely
mm-hmm.
necessary for the Fed, in its mind, to achieve its inflation goals and prevent the inflation from getting into a wage price spiral. I would say right now, that's their biggest concern. Recession is not their
Hmm.
biggest concern. Recession should be Joe Biden's biggest concern. It's not the Fed's biggest concern right now. It's actually something they'll need to get the inflation rate back down to 2%, which is what they continuously tell us is their holy grail objective.
Do you think, though, that the Fed, because this was getting priced into the market about a week ago when we had a nice rally, do you think the Fed will end up having to pivot because there is just too much pain, whether it's in the equity markets or the fixed income markets, the amount of debt that's been created over the past decade, and the interest payments on that debt globally for central bankers and sovereigns around the world? Do you think that they will end up pivoting and lowering rates? It doesn't sound like it, but
Not a
it's
chance. Not
possible.
a chance.
Not a chance.
Maybe second. Not a chance. Something would have to break. I mean, you'd have to have a total dislocation in the financial markets, like what happened in the UK. Even in the UK, with the Bank of England gave really a band-aid on a wound for a couple of days, extending their QE. It would take actually nothing on the economy on a near-term basis. It would take really a financial accident for the Fed to pivot anytime over the near
Okay.
term.
Okay, so David, in the last segment, you said not a chance that the Fed will pivot unless there's some major break. I want to get your take as well, of course, what all of that means in terms of the US Federal Reserve as it relates to Canada. I know we talk a lot about the Fed, but the Fed really does drive, well, you say it drives all asset classes, so that's why we're spending a lot of time on it. But how does this relate to Canada? And then I want to get your take on how we should be positioned.
Well, Canada is following the same monetary policy. Tiff Macklem is going pretty well basis point for basis point with the Fed, tightening into an inverted yield curve. Uh, Bank Canada, the Fed, they are tightening policy into an inverted yield curve. That makes the recession call practically 100% for the coming year. The first half of this year was really food and fuel shock on real spending activity. We haven't seen the interest rate shock yet, and that's the one thing, Catherine, we got to keep in mind is that there are lags that are long and variable between what central banks do, including the Bank Canada today, and then the peak impact really happens really in the coming year. It's going to be a very difficult year next year for the economy. And in terms of the view on the stock market doesn't bottom until we're 70% of the way through the recession and 70% of the way through the central bank easing cycle. So if you're hoping for, buying the dips, I think if you're a Paul Tudor Jones type of trader, go for it. If you're not, I would resist that temptation. The fundamental lows probably aren't going to be until the later end of next year. The Fed and the Bank of Canada have to cut rates. They're not cutting right now. They're tightening into an inverted yield curve. Once they cut rates and re-steepen the yield curve to a more normal shape, which would be good news for the banks, that's when the bottom is put in. So I would say that you want to have minimal exposure to equities. And if you're going to be in the equity market, you really want to be in areas that have long-term thematics that have nothing to do with the economic cycle or the Fed or the Bank Canada, cybersecurity, aerospace
Mhm.
defense, green, green energy and the like. There's pockets you can pick that have nothing to do with the rate cycle or the economic cycle, but are long-term thematics. Outside of
And
that, the asset
yeah.
class that I like the most I like the bond market here. People look at me like I'm crazy. There is a lot of inflation and a lot of Bank of Canada and a lot of Fed priced into the bond market. And
Which,
historically, the first asset class that goes into the bear market is the first asset class to come out of the bear market. It's classic financial accounting 101, FIFO, first in, first out. And
mhm.
everybody, including you and me, and I'm the perma bear, right? I'm dying. I'm dying to see the stock market bottom so I can actually turn into a perma bull. But you see, there
Wow.
is no bottom in the stock market. The bottom in the stock market cannot take place in advance of a rally in the bond market. The stock is chicken or the egg. Chicken has to come first. So Treasury
Okay.
yields, Government of Canada bond yields have to come down to reestablish a more adequate equity risk premium, which is what you typically get at the lows. So I actually would say if you're going to buy dips right now on price declines, I'd be buying the bond market.
And 30 years?
Yes. Well, 30
Yeah.
years is where you'll get, there's duration risk, but then again, we've already gone through the mother of all bear markets in fixed income, and they were the first
Hmm.
asset class. And like I said before, I think that inflation, look, it's being very, very sticky. I was very disappointed on the CPI number, but I'm still convinced that the coming recession is going to bring those inflation numbers down materially in the next 12 to 18 months. I think we have to be a little bit patient. But yeah, I'd say that if my forecast comes to fruition, I think that the total return at the long end of the yield curve will be at least 20%. Okay.
So you can
If
make,
you're going to give me
yeah,
12
make
months,
20%
12
on
months,
30 years.
because of the
Yep.
convexity, yeah, I think that's what you want to buy your long bonds. I don't think the stock market, Catherine, is making it 20% in the next year. I think the
Right.
bond market after what's already happened, look, the higher they go, the harder they fall. We're seeing that in stock prices. But I think the bond market, you see, when you're just taking a look at what ultimately will cause the conditions, it was no different under Volcker, right? Volcker was the biggest inflation dragon slayer of all time. He also was the biggest industry cutter of all time. The Fed, you asked me before about the pivot. The pivot will come, and the rate cuts will
Yep.
come, probably not till the second half of next year. And when they do, the yield curve will steepen. You'll get the biggest return with a bull steepener in the yield curve. Where you'll want to be total return wise will be at the very long end of either the Treasury market or Government Canada market.
Got it. David, great to get your insights as always. And it is always too short. And yet we have a nice long program. Thank you so much for joining us today. Really appreciate it.
Great seeing you again.
Thank you. And thanks for watching, everybody.